Welcome to Markets Now. I'm Michelle Rook along with John Heinberg with Total Farm Marketing. We ended on Friday with grains lowered, livestock to the plus side. And John, the pullback in the grains looked like we were just removing weather premium.
Very much so. Friday morning we had rain on the radar that had good coverage kind of through the central to the eastern part of the Corn Belt, and then continued forecast for additional moisture maybe building as into the weekend. So we'll have to continue to watch how that plays out. Now we're starting to shift our focus on those longer range forecasts in August. And those models are starting to show cooler temperatures for the majority of the grain belt with above average to above average precip. And that's just going to wind up being key here in August as we're filling that kernel out or filling out the pods and beans. So the market just started taking that premium out today, just kind of moving out of some of the concern that we had earlier in the week.
So we didn't even get much reaction to more export sales on the soybean side of things. And we had like 66.5 million bushels for the weekly total. Did the market not react to that because we're behind on new crop export sales or what?
I think it's a combination of things kind of still building there. Right now the U.S. bean has moved to the more competitive bean for that October, November, December window. And it's no shock. As soon as we got there, we started seeing some business come in from China, unknown destinations, and Mexico here. Now, from there on, we'll probably continue to see those sales move. Now, we do have to get caught up. We're about 60% behind where we were last year. Now, that doesn't mean we're going to be that poor on the demand side, but we need to keep things moving. So the market's going to continue to price itself to keep that demand available, taking off from running through 14 and up to the upper 14s in this window to shut that door. We want to make sure we still at least keep those beans moving. And I think that was some of the price action. Plus, again, throw in that weather. Now maybe that yield of 52, which the USDA is still holding on the balance sheet, might be achievable, especially given the conditions from earlier this spring. And if that's the case, then that 300 million bushel carryover that they're kind of targeting right now, at least in terms of the last report, that's still a fairly decent supply of beans, at least around that window. And that might be where prices are moving to, just kind of understanding that could be where the balance sheet is.
So how much technical damage did we do to the charts this week in both corn and soybeans? I mean, we closed November below the $14 mark. Where do we project to now?
Yeah, you go look at all three of the crops here. It's been a difficult week overall. Corn futures, even though we did finish a little bit higher on that December contract on the week, we're still almost 40 cents off the high from the earlier in the week. Plus just the closes today, kind of just taken out through those moving averages. We had the 100-day, 40-day, 50-day, all closed under those on Friday. That just continues to just bring in some more technical selling. Maybe we go back and check that 480 low, especially if the weather kind of confirms over the next few days or over the weekend. The funds got them room to push this thing as they kind of narrowed up that short position a little bit. Soybeans, same thing there, negative on the week, well off the highs from midweek. And again, there with that, we put a bearish reversal on the daily charts on Thursday, got good follow through off of that on Friday. That just opens us up, probably go test around that 1330, 1340 window. Got some support there with the moving average 100 days sitting there. If we really would break, then that $13 mark is not too far out of the question. We haven't touched on wheat. Wheat was 70 cents off the high for the week. Again, just showing the difficulty that wheat market has in holding on to any rallies.
Yeah, since you brought up wheat, do you think that unless we get some big Black Sea war headline that market's going to have a hard time going back up and testing those highs from this last week or not?
I think that's going to be still the key is what happens in that Black Sea region. Obviously, that brings a lot of volatility in the markets. We saw a little touch of that on Friday, just with some potential rumors or possible retaliation attack in Russia. And then boom, we popped 20 cents. And then the market kind of just said, that's not a big enough event. And down we rolled right back into negative territory. So it just tells you how quickly this market can react. To me, it was a disappointing week in the weak markets in terms of how not holding on to those gains. Just again shows you that U.S. prices are just not competitive to those global prices. And we really can't afford to push them up too much higher to keep the demand in, to keep wheat product moving, especially when we're competing against those Russian wheat prices, which this week, President Putin, handing out free wheat to those African countries just kind of shows you again how much supplies they may be sitting on, willing to make that type of a move and how that affects price.
Yeah. So you mentioned the fund positions here, and we're not heavily short or heavily long here in corn or soybeans, and so what is the cue that the funds are going to need here to, either establish a shorter or a longer position in these markets? What are they watching right now?
Combination of two things. Obviously, I think that, what's going on in the Black Sea region. Do we get any major escalation that would make the funds short in corn and wheat very, very antsy? But the biggest thing I think right now is just going to be anything in the weather side. And if these longer range forecasts in August do kind of hold together, looking at cooler average temps going into August, average rainfall, maybe a little bit above average in the southern part of the Corn Belt. That's just going to help this crop kind of finish out as we're getting into those key areas. So if that crop stress gets minimized, the funds are going to feel very, very comfortable, especially in corn. You can continue to push the backside of this thing. A lot of us in the analyst world still feel the demand is heavily overstated on the corn side. So if that yield does not come down and USDA has to make some demand adjustments, that's only going to add to the corn pile. That's the thing that's got me the most concerned going forward, is just we need to see some demand, and we're struggling like that in the corn market versus those cheaper competitive South American crops, just like we are in the wheat market versus the Russian wheat and what global prices.
Yeah. So cattle market ending higher on Friday. It looks like the feedlots kind of digging in their heels here, hoping for some higher cash trade. Yet the packers are seeing negative profit margins here, trying to slow kill down with kill cuts. Who wins out? What do you think?
It's going to be interesting. First off, too, you're looking at Packers starting to lose some of their margins right now. So they want to tighten up the supply so we can get the retail values to kind of pop again to validate the 180 plus cash numbers that they may have to put out there. At the same time, we're looking at a situation where the supply is still extremely tight, coming off of probably a difficult week in terms of growth, because of the temperatures going through, so that could keep some of the weights down. So it's going to be interesting to see how this kind of plays out. The standstill that we have in cash, eventually the Packers still need to meet demand. They still need to have product to move. They'll still probably have to at least blink. One of the other sides on that cattle side I'm watching very closely, the charts have kind of looked very, very tired. We put a fairly big reversal in a week ago. We just haven't seemed to really get any traction off that. So maybe even seasonally here, the cattle market might be moving into a little bit more of a sideways play versus, rallying higher, even if cash trade were to stay firmer.
And to your point, we did have lower weekly closes here in both live and feeder cattle futures in these front months. And so that probably is another negative technical indicator, right?
Very much so. And again, just, this market has been heavily long cattle in terms of the money position for a long time. Might be time for them to say, we're not getting anywhere anymore. We're at record high prices. Sometimes money flow can dictate things even regardless of the fundamentals. So I'm a little cautious there right now. Again, make sure there's still good value, and producers should be looking at puts underneath this market. And the other flip side of it is, if all of a sudden the weather looks good in the grains, corn prices go ahead, break through those new lows, that's going to put some value back in feeders, and that'll probably trickle over and support that cattle market as well in terms of live cattle.
Yeah, I don't want to count the cattle market out, because every time we have a pullback, it seems like it gets bought. So hog market, August made new highs for the move today, took out that old chart resistance area, but this has been really a index-led rally. It's extended longer seasonally than normal. Much longer does it go, John?
Well, right now we're looking at really good value on the retail side, 114 for pork carcasses. That just keeps some money on the, out there for the packers to keep bidding for hogs. We're really watching what's going on the demand side. Does China step into the export market, pick up some U.S. pork here? We'll have to kind of continue to watch what's going on in those export sales. It's really realistically a flip side of when we sold this thing off for so long during the spring months. We were constantly chasing lower on the index, and we just could not get that value out of the futures market fast enough. Now it's the other way around. Index is trending higher. Futures are at the discount to the index, so it just feels like we got some room to go. Even when we get the August contract off the books here in a few weeks, we got to look at October and December, way under that index, trading in the $70, $80 handle. There might be some room for this hog market to go, as long as those demand factors, retail values continue to stay supported here, at least in the near term.
Yeah, that discount gets bigger in the back end of the board, that's for sure. All right, thanks for joining us. John Heinberg with Total Farm Marketing. That's Markets Now.